Hello everyone. In this video, we shall discuss about the different investment and borrowing problems, and we shall explore on the different investment options and as well as applications of um, several regular payments that includes annuities and amortization. So first, let us discuss what is simple interest. Simple interest is where the interest rate is fixed over a period of time. So this means that when we invest over a period of time or when we borrow over a period of time, the money or the amount invested or amount borrowed will earn or will be charged an amount of interest once over the given period of time. The formulas that we will use for simple interest would be capital I is equal to P times I times T, where capital I is the amount of interest earned or amount of interest charged, while P is the principal amount or the amount invested or amount borrowed, while small r is the annual interest rate or the simple interest rate. And when we use this in the formula, it must be in decimal form. So for example, if the interest rate is 6.5%, then we shall divide this by 100 and we get r is equal to 0.065. And this value must be used in the given formula. Now, the small t is actually the term of investment. So this is the length of time where we invest or borrow money. So this quantity or value must be in the year unit of measurement. So which means that if the term of investment is 5 years, then T must be equal to 5. But if the term of investment is in months, let's say 9 months, then the time T must be 9 months divided by 12. And when this term of investment is in days, then we have to divide the number of days by 365. So for example, if the term of investment is 275 days, then we have to divide it by 365. Now, if you want to know the amount of money after the investment or the total amount to be paid for borrowing problems, then we shall compute for the maturity value, capital F. And this maturity value is also referred to as the future value. Now, this maturity value F is computed using the formula the amount of the principal plus the interest earnings or interest charges. And this can also be computed using the formula P times the quantity of 1 plus rate times time. Now, for example, if we will apply simple interest in investment, we have the following problem. So suppose that you invested 300,000 pesos in an account that earns 4% simple interest in 3 years. Now, how much is the interest earned and what is the maturity value? Now, in this case, the 300,000 is the amount invested, which is the principal, and the annual interest rate or the simple interest rate is 4%. So which means that we have to convert this in decimal form. So R must be 0.04. Now the term of investment is 3 years. So that means T is equal to 3. And in this problem, we are looking for the amount of interest earned, which is capital I, and the maturity value, which is capital F. So first, let's compute for the amount of interest earned, which is given by the formula P times I times E, and substituting the appropriate values for P, R, and T, and using our calculators, then we get I is equal to 36,000 pesos. So 36,000 pesos is the amount of interest earned for this particular investment. Now, for the maturity value, we can just add the principal and the amount of interest earned, and that gives us 336,000 pesos. So, assuming that there are no additional deposits or there are no withdrawals made over the term of investment of 3 years, then that means at the end of 3 years, the total money in the account is 336,000 pesos. Now we can also compute for the maturity value using this formula and substituting the appropriate values, we get the same amount of 336,000 pesos. Now next, let's apply simple interest in borrowing problems. Now this time, suppose that you borrowed 500,000 pesos from a lending institution that charges 5.5% simple interest. Now you promise to pay after 9 months. How much amount must be paid? So in this problem, the amount borrowed is the principal, which is 500,000 pesos. And the simple interest rate or the annual rate is 5.5%. And in decimal form, this is 0.055. The term of investment is 9 months. So T must be divided by 12. So that should be 9 over 12. And we're looking for the amount that must be paid at the end of 9 months. And that will be our maturity value, F. So using the formula again, F is equal to P times 1 plus rate times time. And substituting the appropriate values, we get 520,625 pesos. Now, if you want to get the amount of interest charges, then we can just subtract the principal from the maturity value. So F minus P will give us 20,625 pesos. And this is the additional amount charged because of the loan or because of borrowing from the lending institution. Now next, so let's after understanding simple interest, now let us try to understand what is compound interest. So compound interest earns interest not only on the principal but also on the interest earned in the prior period. So in compound interest, it's possible that the investment will earn interest many times or a number of times in 1 year. And if in the case of borrowing, it's possible that the interest charges will be applied a number of times in 1 year. Now, the formula for the maturity value when compound interest is applied is given as follows. So it's F is equal to the principal times the quantity of 1 plus the rate R over M raised to M times E. So in this case, the R here is still the annual rate, but that annual rate is compounded several times in 1 year. So the number of times that the rate is compounded in 1 year is the frequency of conversion, which will be the value of M. Now the P is still the principal, the time T is the term of investment, which is in years. And again, R is the annual rate, while M is the frequency of conversion. Now, this frequency of conversion could be M equals 1, M equals 2, M equals 4, M equals 12. So this will be the usual values of M that we will use for our discussion. So when we say M is equal to 1, it means that the interest rate is compounded annually. When M equals 2, it is compounded semi-annually. While when M equals 4, the interest is compounded quarterly. While for M equals 12, the interest is compounded monthly. So let's have an example. Usually, compound interest is applied for one-time payment borrowing problems, or sometimes it's also applied in several payment borrowing problems. Now, suppose that you borrowed 50,000 pesos from a bank that charges 2.5% interest compounded semi-annually, and you promise to pay in 2 years. How much should you pay the bank? So in this problem, the amount borrowed is the principal amount, which is 50,000 pesos. The annual rate is 2.5%. So this will be R is equal to 0.025. And since the rate is compounded semi-annually, that means the value of the frequency of conversion N is 2. And then the term of investment is 2 years, which means that T is equal to 2. Now for the question, we're looking for the amount that we have to pay the bank. So that means that's the amount borrowed plus the interest charges, which is the maturity value F. So in compound interest, the formula for F is given as follows. And if we substitute the appropriate values for T, R, M, and T, we get the following solution. And then using our calculators, we get 52,547.27 as the amount that you need to pay the bank at the end of 2 years. So this means that the interest charges is computed using F minus T. So which means 52,547.27 minus 50,000 is 2,547.27. Now, these simple and compound interest are applied to different accounts or investment options like the savings account. So applications would be about savings account. So a savings account is a place where you can store your money securely while earning interest. In savings account, we can deposit and withdraw anytime, and the bank pays you interest on the money that you leave in your account. But this interest is actually very, very small interest because most Philippine banks, they only use like less than 1% annually for the interest rate, for a client to earn some money. So your money is insured up to 500,000 pesos to the Philippine Deposit Insurance Corporation or PDIC, just in case that something bad happens to the bank. So your money is insured, but only up to this amount. So you're not assured of getting fully the money that you invested in the account. Now, there are various types of savings account, and this depends on the amount of initial deposit. So this is the amount that you give the bank in order to open the account, while ADB is the average daily balance. And also the savings account will also depend on the average daily balance for the account to earn interest. Now, of course, realistically speaking, when we say savings account, it means that the account is moving. So that means the amount or the balance in the account changes over a period of time. So in that case, how are we going to compute the interest earnings in case of an investment problem? How do we compute the interest earnings if the account is moving? So let's have this particular scenario. So given the following account information for the month of August 2020, how much is the interest earned by the account for the month of August only, assuming an interest rate of 1.25% per annum. So this is the annual interest rate. And this is the account information. So as you can see, August 1, 2020, at the start of the month, the balance is 54,000 plus. And then after several days, on August 11, the account is now updated and the balance is now higher than the previous one, which is 78,506.98. And then after one day, it changes again to 73,000 plus. And then after several days, it changes again to 60,000 plus. So what we want to know is the amount of interest earnings for the month of August, given this particular scenario. So the question would be, should we use the last balance or should we use another quantity in order to compute for the amount of interest earned? So in that case, the answer is we should compute for the ADB of the account for the month of August. And the ADB is the average daily balance. So how do we compute this average daily balance? So the balance of 54,275.62 is maintained from August 1 up to August 10. And then on August 11, it changed to 78,506.98. And then on August 12, it changed again to 73,506.98. So that means this amount here, this balance here, stayed for only one day, no, on August 11, because it changed in August 12. And then on August 21, the amount changed again to 60,453.71. So we have to count the number of days for each of these rows. So from August 1 to 10, starting from 1, and then we count up to 10, there are 10 days. So we have to multiply the balance by 10, and we get this value. And then for the second row, since this is only 1 day, we multiply the balance by 1, and we get this value. And then in the third row, the number of days from August 12 to August 20 is 9 days. So we have to multiply the balance by 9, and we get this thing. And then on August 21, up to the end of August, the balance stayed at 60,000 plus, and that is 11 days. So we have to multiply this by 11, and we get this amount. And then all the products here must be added. So the total is as follows. And this total must be divided by the total number of days in the month of August, which is 31 days. So dividing that by 31, we get 62,832.8, which is the average daily balance. So this value is not really the actual amount in the account, but we know that the actual amount is 60,453.71, which is computed for the average daily balance in order to compute for the interest earnings for the month of August. So in that case, we shall use the formula for simple interest rate. So I is equal to principal times rate times time. So the principal is the average daily balance. This is the ADB. And then the rate is 0.0125 because according to the previous slide, it's 1.25% per annum. And then the time T is 31 over 365 because the month of August has only 31 days. And we need to divide it by 365. So using our calculators, we get 66.71 as the interest earnings for the month of August. But usually when we earn interest through bank accounts, our earnings are subject for 20% withholding tax. So we shall have examples of those later in the next slides. Now, another type of account would be the time deposit account. And what is a time deposit? Now, this is a certificate of deposit, and it is a bank product that is almost the same as savings account. With time deposit account, our money will be kept by the bank for a fixed period of time, let's say 30 days, 60 days, 90 days, for an interest rate that is slightly higher than the savings account. Now, since it is in time deposit, it must be kept in the bank for the the fixed period of time. So let's say if you agree for 30 days or 60 days, then you have to keep your money for that particular period. But let's say you needed money after a certain number of weeks, that is before the maturity date. So in that case, you can terminate your time deposit account, but it will result to a penalty from the bank. Now, because the bank shoulders the DST or the documentary stamp tax, and that tax law must be now passed to the client because the client terminated the account before the maturity date. Now, interest earnings on time deposits, so just like as I have said earlier, in savings account, it is subject to a withholding tax of 20%. And also similarly, time deposits are covered by the PDIC up to 500,000 pesos. So let's have an example for time deposit account. So let's say Oliver has 500,000 pesos and is looking around for a bank where he can leave his money for 6 months or 181 days. So it can earn interest via time deposit. Now let us help him complete the following table so he can decide which bank to choose. So there are 5 banks here: PBI Direct, Korea Bank, DBO, Cosmo Bank, and SB Bank. Now, the interest rates are as follows. So, these are the annual interest rates. 2.25% for TBI Direct, 2% for Korea Bank, and so on and so forth. Now, however, these banks use the following divisors for the time T, for the term of investment. So, TBI Direct, Korea Bank use 365 days, while DBO, Cosmo Bank, SP Bank use 360 days. So, if the term of investment for the time deposit is 151 days, then 181 must be divided by the divisors that are currently or that are being used by the said banks. So in here, to compute the interest earnings now after 181 days, we have to multiply the principal, which is 500,000, by the rate. So in this case, it's 0.0225, and the time T is 181 over 365 for PBI Direct, and the interest is 5,578.77. So that's the earnings. But of course, these earnings are subject to a 20% withholding tax. So if we're going to less 20% to this, that means we are getting only 80%, or Oliver is getting only 80% of these earnings. So which means if we multiply this by zero point 0.8, then that is the amount of interest earned after the withholding tax is deducted from the earnings. So that means 4,463.01 is the interest earnings after the deduction of taxes. Now, if we follow this formula or formulas na for the rest of the rows in this table, we will be getting the following summary. So these are the values, so you can maybe compute this in your free time. But of course, you have to keep in mind that you have to use the divisors adapted by the following banks. Okay, now let's proceed with applications of the simple compound interest in several regular payments. So in several regular payments, there are times that we want to buy a very expensive item, let's say a condominium unit, a house and lot, or a car, or even a very expensive appliance or a smartphone. So in that case, we don't have a large amount of money to shell out. So which means we can pay using a down payment, and then the remaining balance will be paid in sequence. Will be paid in sequence regularly. Let's say for 2 years, or for each month, for 2 years, or for each quarter for 2 years, depending on the contract or agreement. So these applications are actually annuities. So an annuity is a sequence of equal payments that is made regularly. And the amount of each payment is referred to as the regular payment, which is denoted by capital R. Now, this capital R could be monthly payment, it could be quarterly payment, so meaning every 3 months you need to pay, or it could be a semi-annual payment, or every 6 months you need to pay, or it can be annual payment, or every year you have to pay. So the formula for R for this regular payment is P times I divided by the quantity of 1 minus the quantity of 1 plus I raised to negative n, where I is equal to the annual rate divided by n. Now, this annual rate is compounded a number of times in 1 year, and that will be the frequency of conversion. Now, the n here is the number of periods for the borrower to finish paying everything. So that's computed using m times t. So for example, now if the interest rate is compounded monthly and you need to pay for 2 years, that means it's 12 times 2, which is 24 periods or 24 monthly periods. So that means you need to pay every month 24 times. I mean, you need to pay 24 times in 2 years. Okay, and then this P here is actually the present value of the annuity. So this is the amount that is to be paid in sequence. So for example, if we're buying, let's say, a condominium unit that has a cash price of 3 million pesos. Now let's say the seller requires a down payment of 1 million pesos. So that means the remaining amount is 2 million and that is to be paid in sequence. Okay, so the 2 million pesos is the present value of the annuity. However, if there's no down payment, that means the cash price of 3 million pesos will be the present value of the annuity. Now, this P or present value of the annuity can be computed using the following formula. So this one is actually derived from this particular formula here. So let's try to have an example. So a smart TV is purchased with a down payment of 5,000 pesos and the balance will be paid at 1,875 pesos every month for 1.5 years. If the interest rate is 3% compounded monthly, what is its cash price? Okay, so cash price is actually equal to down payment plus the present value of the annuity. Now, in here, we have the down payment, which is 5,000 pesos. So this is 5,000 pesos plus the present value of the annuity. So in order to complete for the cash price, we need to solve for the present value of the annuity. And P is equal to R times this particular quantity. Now, R is the regular payment. So according to the problem, the balance will be paid at 1,875 pesos every month for 1.5 years. So that means this is our R or capital R. And then the small I here is actually equal to the annual rate divided by the frequency of conversion. So the annual rate is 3%, which means that it is 0.03. And since it is compounded monthly, that means n is equal to 12. So 0.03 over 12 is as follows. And then the value of n must be computed using n times t, which means every month, so 12 months times 1.5 years, which is 18 months. So this means that we need to pay 1,875 pesos 18 times. And that's good for 1.5 years. So substituting the appropriate values into the formula of P, we get the following, and the present value of the annuity is 32,961.62. And if we add it to 5,000 pesos, that's going to be the cash price of the smart TV. Now, whenever we apply annuities in order to pay a very expensive item regularly in sequence, then an amortization schedule may be prepared in order for you not to be updated in your payments. So whenever you are updated with your payments, you need to know how much interest is paid for a particular period and how much is the outstanding balance after you've already made several payments previously. So the term amortize would mean that you need to have a copy of your amortization schedule. So an amortization schedule is a table which shows how a debt or loan is completely repaid through periodic payments. So the periodic payments, these are your payments every period. So it can be monthly payment, semi-annual payment, quarterly payment. Now these payments, of course, would include the amount of interest charged for each particular period, and of course, the principal repayments. And then to recall, these are the formulas again for R, P, I, and N. So let's have an example. Suppose that you applied for a 65,000 pesos loan at 12% compounded semi-annually, and this is to be amortized every 6 months for 2 years. Now let us find the semi-annual payment and construct an amortization table. So this 65,000 pesos loan, this is the present value of the annuity. This is to be paid for 2 years, every 6 months for 2 years. And then the 12% here is R. And since it's semi-annually, that means N is equal to 2. And then the term of investment is T equals 2. So to compute for the semi-annual payment, that's going to be capital R, and it's given by the following formula. And we know that I is equal to R over M. So that's going to be 0.12 over 2, which is 0.06. And then M is computed using M times T. Since M is 2 and T is 2, then N must be equal to 4. So this means that in 2 years, there should be 4 periods or 4 payments. So that means you need to settle this loan with the corresponding interest charges 4 times, not in 2 years. So you have to finish it paying 4 times, not in 2 years. So the semi-annual payment here, using this formula and substituting the appropriate values, then we get 18,758.45 as the semi-annual payment or the regular payment. So we shall use this amount whenever we construct the amortization schedule. So how do we construct the amortization schedule? So first, you need to prepare a table having 5 columns. So the first column here would consist of the different periods. The second column is the periodic payment, and that is actually our capital R. Third column is the interest payment. Fourth column would be the principal repayment. And the last column is the outstanding balance. So now for the rows, since we computed n to be equal to 4, so there must be 4 periods, but our first row should be period 0. So in period 0, we don't put anything in the periodic payment, interest payment, and principal repayment, but we have to put the present value of the annuity, which is 65,000 pesos. So, which leads us to the following second table in this slide. So the 65,000 is here in the outstanding balance in period 0. And then we put the value of the periodic payment R that we have solved in the previous slide. So we have to just copy this amount for every cell in the first row except in the period 0 cell. And then the next step here is to compute for the interest payment for period number 1, the principal repayment for period number 1, and then the outstanding balance after we have made the first payment. So the interest payment here is computed by multiplying the outstanding balance by I, which is 0.06. And that's going to be 3,900 pesos. And then this principal repayment is computed by subtracting this 3,900 from the periodic payment. So 18,758.45 minus 3,900 will give us 14,858.45. And then for the outstanding balance, so the previous outstanding balance, which is 65,000, and then we subtract the principal repayment, and that's going to be the new outstanding balance. So that's going to be 50,141.55. So repeating these steps, for the cells in period number 2, we have to multiply this 50,141.55 by I again, which is 0.06. So that's going to be 3,008.49. And observe that the interest payments are decreasing every period. Uh, it's because our outstanding balance is also decreasing. So the interest charges will also decrease every period. Now, the effect of decreasing interest payments would be that the principal repayments would increase. So subtracting this two, we get 15,749.96. And then subtracting this amount from the previous outstanding balance, we get 34,391.59. And we get the following table. So now for period number 3, again, you multiply this by I, which is 0.06. So we get the following. So the interest payment will be 2,063.5 for period number 3. And then the principal repayment will be 16,694.95. And then subtracting this from the previous outstanding balance, we get 17,696.6. Now, of course, for our last row or last period, we expect that the outstanding balance should be 0. So continuing in this manner, multiplying 17,696.6 by I, which is 0.06, we get 1,061.8 for the interest charges. And then subtracting this from the periodic payment, we get 17,696.65. But if we subtract this amount from the outstanding balance, we will be getting negative 0.05. But actually, this must be equal to 0. It only happened that this is not exactly 0 because along the way, we keep on rounding off. So that's why there is a little discrepancy in the following cell. Okay, so it must be 0 in actual. Okay, so this amortization schedule may also be prepared using Microsoft Excel. So you can maybe explore on doing the Excel thing for this amortization schedule. Okay, now this example here shows us how to compute the outstanding balance so without referencing from the amortization schedule. So let's suppose that the 65,000 peso loan at 12% compounded semi-annually is to be amortized every 6 months for 2 years. This is the exact same problem that we had earlier in the amortization schedule. And our task is to compute for the outstanding balance after 1.5 years. So that's going to be after 3 payments, 1.5 years, that means after 3 payments. So the outstanding balance must be 17,696.6. But if we don't have the amortization table, we can compute for R first, which is 18,758.45. And then we have two options in computing for the outstanding balance. So it could be the prospective method. So using this prospective method, we use the following formula for the outstanding balance. So the outstanding balance is denoted by OB sub K. And this K here is the number of payments made. So in this case, if we are looking for the outstanding balance after 1.5 years, that's going to be the value of M times this 1.5, so which is 3. So that means after 1.5 years, there are 3 payments already. And then the value of R is 18,758.45. I is 0.06. And then N is equal to 4 because remember in this problem, if we need to finish paying in 2 years, that's going to be the frequency of conversion times 2 years, which is 4. So there should be 4 periods minus K, or minus the three payments made already. So in this case, it's 4 minus 3. So we get 17,696.65. So that's the outstanding balance using the prospective method. Now, there's another way of computing the outstanding balance, and it's the retrospective method. And this is the formula for that. The difference of the prospective and the retrospective lies on the presence of n. So in the prospective method, n is present in the formula, but in the retrospective method, we don't have n in the formula. Okay. N, by the way, again, n is the number of payments to be made in order to finish paying the loan or the debt. So let's try to um, illustrate this retrospective method. So a travel agency moved to a new building to service a bigger client pool. The building was acquired through a 15 million peso bank loan with 12% interest compounded monthly. If the agency amortizes the loan with monthly 200,000 peso payments, what is the outstanding balance in 5 years? Okay, so here, the bank loan, 15 million, is the present value of the annuity, which is P. The 12% here is R. And since it's compounded monthly, that's going to mean that N is equal to 12. And then the monthly 200,000 peso payments is our capital R. So in this case, in this problem, we don't know when will this bank loan be finished. No, when we pay monthly, no, using 200,000 peso payments. But we are looking for the outstanding balance after 5 years. So in this case, we don't have N. So we shall use the retrospective method for computing the outstanding balance. But in this case, the K will be 5 years times the frequency of conversion. So 12 times 5 is equal to 60. So which means in 5 years, we already made 60 payments, 60 monthly payments. So the outstanding balance after 60 monthly payments is OB sub 60. And P is 15 million. And then the I is actually computed using the formula R over M. That's going to be 0.12 divided by 12, which is 0.01. So that's why 1 plus I is 1 plus I here is 1.01 and our K is 60. Now the value of R is 200,000 pesos. And then we have again 1.01 raised to 60 minus 1 over 0.01. And that's going to mean that it's 10,916,516.51. So this is the outstanding balance after 60 payments. So now that's the end of the discussion for the simple interest and compound interest applied in investing and borrowing problems. So let's move on to the other investment options. So another investment option would be to invest in stocks. And stocks represent shares of ownership in a company. So company issues issue shares of stocks to different people or to different clients, and the clients will buy those shares, from those companies. So when people buy shares of stocks of a company, they become part owner of the company. A share represents a unique ownership of a corporation's profits and assets. Ownership can be quantified by dividing the number of shares owned by the number of shares issued. So, for example, if a particular company, let's say company A, issues 2 million shares of stocks, and then you as a buyer, you're going to buy 100 shares of stocks. So that means 100 shares of stocks that you bought divided by 2 million, 2 million shares of stocks issued by the company, there will be the proportion or fraction that you own, no, for the company. So, for example, um, if there are four shares of stocks and you only buy one share out of the four, then that means you own 25% of the shares of the company. So, to have a more clear understanding of that, suppose that these four people are the only owners of shares of stocks of a company, and all of them invested with the same amount of money. So this means that each of them owns one fourth of the business or one fourth of the company. But in the second figure here, as you can see, not all of them have the same amount of investment. So this one is the highest investment. So if we get the total of all of these, the total is 70 million. So that means this person owns 2 over 7 or 20 over 70. This one owns 10 over 70 or 1 over 7. Also, this one owns 1 over 7 of the company. But the fourth person here, since he invested 30 million pesos, so that's 30 million over 70, which is 3 over 7. So that's the idea of stocks. Now, how do we earn from stocks? So we earn from stock appreciation. So this means that when prices go up or go down, so when prices go up and then when you sell shares of stocks to other people, then that's one option for you to earn from stocks. So when prices go up or down, we can buy or sell stocks. And then when do we buy and sell? So we buy whenever the prices go down, and then we sell when the prices go up. So once the prices go up, that means you're going to earn some money because you bought it at a much or at a lesser price or at a much lesser price. Now also we can earn from stocks through the form of dividends. So if the company receives significant earnings, they distribute this to the shareholders through dividends. Now, why do companies issue stocks? So why do they sell shares of stocks? So in order for them to raise funds for a possible business expansion. So that's one reason. So business expansion would be an opportunity for them to increase their money, to increase profits, to increase their budget. So so they need to raise funds in order to expand the business. Now, when they receive profit due to this business expansion, then the shareholders or the buyers of the shares of stocks may receive dividends. Now, in stocks, there is a term which we call the initial public offering or IPO. And this is the term used when a company issues shares of stocks for the first time. Now, of course, though, if you want to know the movement of the stock prices, then you need to monitor it through the Philippine Stock Exchange or the PSEI. Now, what are the types of stocks? Now, we have common and preferred stocks. So, for common stocks, no, the great majority of stocks are issued in this form. So that means when people talk about stocks, they refer in this format. So when you hear people talking about stocks, it means that they're talking about common stocks. Now, common stocks have the biggest potential for long-term gains. However, stocks in general is a high risk and a high reward type of investment. Of course, no, when you earn money from stocks, it would be higher than investing your money into savings or time deposit accounts. But it is a high risk investment because of the possibility that the stock prices of a company would go down because of, let's say, a company controversy and etc. Now, common shareholders or buyers of common stocks have more control regarding the future of the company as they can exercise voting rights in electing the board officers of the company. However, common shareholders stand to lose most when a company goes bankrupt. Now, it is because the companies would pay the creditors first. If the company owe another company or some group of people, so those are the creditors. And then the company should also pay the buyers of preferred stocks first before they pay the common shareholders. So holder, but preferred for preferred stocks, the holders of preferred stock cannot vote, but they are guaranteed a fixed dividend before any dividends are distributed to other shareholders. And in the event of bankruptcy, shareholders of preferred stocks are paid off after creditors and before common shareholders, just like what I said earlier. Now, so why do companies issue preferred stocks? Now, companies can get more funding with preferred shares because some investors want more consistent dividends and stronger bankruptcy protections than common shares offer. So, which means that if you are a buyer, of course, you would want preferred stocks over common stocks because preferred stocks are, of course, preferred. No? Preferred stockholders are paid first before the common shareholders. Now, for stocks, so when you invest in stocks, so you need to research about the ROI of the stocks of a company, and ROI is the return of investment, and it's given by the formula appreciation in price plus the dividends earned divided by the initial stock price. So suppose that you own shares of a company which just paid you 20 pesos per share in annual dividend. So the dividends is 20 pesos. If the original price per share is 1,000 and the current price per share is 1,020, then the appreciation in price is the current price minus the initial price. So that's 1,020 minus 1,000 and then added to the dividends. So you get 40. And then when you divide it by the initial stock price, which is 1,000, and multiply it by 100%, you get 4% as the return of investment. But these ROIs are just guides, for future investors. But there's no guarantee that when you invest into a company that has a 4% ROI, there's no guarantee that you will get also 4% when you invest because these ROIs are based on past performances of the company. Now, to start investing in stocks, so you may want to visit this particular site. So, in order for you to have an idea on how to start investing in stocks. But of course, when you invest in stocks, uh, you have to make sure that you already have a savings account, you have enough money, you already have emergency funds and other insurances. So we only invest in stocks whenever we have excess in money. So something that or some money that we don't have or some money that is really already an excess, no, from your funds. Okay, so which means in investing in stocks, if you have money wherein you don't know where to use it, then you invest it in stocks. The next type of investment option is bonds. Now, a bond is a loan, but you're not the one applying for a loan. It's the corporation or the government who actually gets a loan from you through selling of bonds. Now, a bond is a loan. Corporation issue bonds to whoever wants to buy them. And then when you buy, you're lending money to the corporation that issues it. Now, the corporation in return promises to pay interest payments to you for the length of the loan. So, which means that it's like your the corporation is borrowing money from you, and then when they return it, they give you interest earnings. Okay, So there are types of bonds. So we have corporate bonds, and these are issued by businesses to help them pay expenses. And then we have the government bonds, which are issued by the government but to fund programs, meet payrolls, and pay their bills. Now, corporate bonds are of higher risk than government bonds, but can earn more money. Because that whenever the corporation becomes bankrupt, then that means the clients will also lose their money. But um, it is safer not to invest in government bonds because the government gets money from the people's taxes. So at least you are sure that the government uh, will not go bankrupt, and that the government will also be able to pay you know your interest earnings through bonds. So the difference of bonds with stocks is that in bonds you're not a part owner of the company, but in bonds, um, if we shall say it, it's actually less riskier than investing in stocks. And the following table here is an example of information about corporate bonds. So in the first column, as you can see, the issuer of the bonds. And then here we have the rates, okay, the rates when you invest. But usually in bonds, so when you invest in bonds, it's usually um, an amount that is a multiple of a certain amount. So let's say if company A would issue bonds, they will require you not to invest, let's say, in multiples of 10,000. So which means you cannot invest 5,000 only. It should be 10,000 or more, but it should be multiples of 10,000. So 10,000, 20,000, 30,000, but not 25,000, but not 15,000. Okay, so it should only be multiples of a certain amount. Now here in the following table, we have an information about a government bond. So in government, no, the one issuing government bonds is the Bureau of Treasury. And it says here maturity date is 3 years from issue date. Interest rate is 4.875%, which is subject to 20% withholding tax. The interest payments are given quarterly. And the minimum investment is 5,000 pesos and integral multiples thereof. So as you can see here, it should be multiples of 5,000. So when you invest here, it should be 5,000, 10,000, 15,000, 20,000, and so on. Now, if you invested 10,000 pesos in this bond, how much interest will you receive quarterly? So to compute it, the interest earned per year with tax deduction would be the principal amount invested times the rate times the time, no, in 1 year, and then you multiply by point 0.8 because we will deduct 20% withholding tax. So that means 80% is uh, the amount that uh, we earn, no, for that year. So in this case, it's 390 pesos. And then since we're asked about the interest received quarterly, so we have to divide it by 4, which is 97.5 pesos. So this interest earnings for in 1 year, when you invest 10,000 pesos, is actually way better than uh, when you invest in savings or time deposit accounts. And then finally, we have the mutual funds. So if you're not into stocks, or if you are not knowledgeable about the do's and don'ts in stocks or in bonds, you may invest your money through mutual funds. A mutual fund is an investment company that pulls together money from different investors and invest them. Now, there are a lot of companies that issue mutual funds, now including banks. So if you want to invest in mutual funds, you can go to some banks and ask their representative in order for them to explain what are the different mutual fund products. Now, in mutual funds, it's like stocks, but there's a certain net asset value per share, which is the NAVPS, and it represents the price of one share. And then the NAVPS of the mutual fund, changes every business day depending on the market performance of the fund. So of course, if there are a lot of investors for a particular mutual fund, the better, the better performance for the fund. Now there are different types of mutual funds. So there is this money market fund, and this type of fund is short term only, usually 1 year or less. And then equity fund, and this fund invests primarily in shares of stock. So in this case, you will invest your money in banks into equity fund products, and then the bank will be the one to invest your money through stocks or to the stock market. Now, bond fund invest in long-term instruments of government bonds or corporation bonds. So this means that when you invest for this type of fund, the bank or the company um, will invest your money in government bonds or uh, corporate bonds. And then fourth, we have the balance fund, wherein the bank or company will invest your money in both shares of stocks and debt instruments. But of course, if you will invest your money through funds through a bank, then the bank will charge you some amount because they're the ones who is doing the work for you, in order for you to earn interest from these funds. So for example, this one is from uh, the trust funds, the unit investment trust funds from BDO. And in here, the money market fund, so the NAVPS is 1,572.71. That is on February 22, 2019. And then if we on February 4, 2020, after 1 year, the NAVPS of this money market fund is now 1,618.1225. So for instance, if you're going to invest 100,000 pesos under the BDO peso money market fund, how much will be your investment after 1 year, on February 4, 2020? So to compute that, we will divide the amount invested by the NABPS on February 22, and that gives us this quantity. And then this quantity shall be multiplied by the NABPS on February 4, 2020, which is this one. And that gives us 102,887.35. So that means after 1 year, your 100,000 pesos earned 2,887.35, which is actually way better if you invest in a savings account that earns only like 0.5% interest annually. So that's the difference of these investments, with savings or time deposit accounts. So what are the good things on investing mutual funds? In investing for mutual funds, so you don't have to select a specific stock or bond fund. The balance fund will automatically choose the stock and bond investment. It's a good choice when the investor is not an expert on investing and not ready to hire a financial advisor. But the not so good things, the fees will be a little higher because you have someone else doing the work of selection for the funds. And then that's it. So this ends our video for the investing and borrowing lesson. So I hope that you learned something from this video. And please do not forget to click the subscribe button for my channel. Okay, thank you for listening.